Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today I'm here with Eric Smith of AppBrilliance. Eric, thank you for joining us.
Oh, it's my pleasure, Hall.
Can you talk a little bit about your background before joining AppBrilliance? What did you do before this one?
Before this company, I ran Unwired Banking, which was a venture-backed mobile banking startup based here in Austin.
Oh, great. And so what led you to start work in the fintech sector to begin with?
Well, we had invented some interesting technology to make application development faster. And so right in the transition with smartphones, when Apple started coming out with the ability to have natively compiled software applications, and it became clear that everybody that had a website or a web application would need a mobile app, we developed a next generation platform to allow that to happen. So one of the most obvious opportunities for high volume mobile application development at the time was in banking. And so we really started to concentrate on deploying and partnering with established trusted companies in that space. And that's how we sort of got involved in fintech from then on.
So we have a lot of investors who listen to the show, and so they're always looking for pointers. So what would you tell someone that's first time investing that wants to invest in the fintech space? What would you tell them to look for?
Well, I'll pass on the advice that I've heard from multiple VCs that have historically invested in fintech, which is that it's a challenging space to invest in because it's the disconnect between the traction that you need to have and the ability to scale is pretty broad. So the story goes that getting the first 10 customers or even the first customer, if you're a fintech company that traditionally sells to, let's say, banks, that's technically impossible because banks should not be, in many cases, are barred from doing business with pure play startups that don't have an established track record. So it's always a huge challenge as a fintech company that sells to entities like banks in getting your first set of customers and your first set of proof points. That's one of the reasons that we're taking a different approach with AppBrilliance and treating banks more as product and less like customers.
Well, so let's talk about the fintech industry in general. How is the industry evolving? What do you see going on out there?
Well, there's the trends right now in fintech specifically are really mirroring the trends that we're starting to see in the broader consumer marketplace, which is a substantial focus on consumer privacy and security. That's something that really a very laissez-faire attitude toward that sort of defined much of the last decade and has led to the growth of the technology platforms as we know them. And over the last 18 months, that foundation has started to crumble a little bit with the various privacy scandals and consumer data scandals and things like that. So I think the industry in general is being forced to come to grips with how do you balance consumer privacy and high data security in a modern world. And that's something that is going to be a particular challenge to a lot of fintech providers and data providers in the fintech space.
What do you see as some of the growth rate factors that are going on? What technologies are really driving the growth rate in the sector?
In general, I think it's really about reducing friction. It's about technologies that can make it easier for people to adopt new platforms and to migrate their relationships with their legacy banking providers or their legacy investment providers and move to some of these next generation platforms. And so a lot of the momentum in the space that's leading to accelerating growth is, the technology platforms that makes that easier. So a good example of that sort of decreases the engagement barrier is look at Venmo or Square Cash. They make it very, very easy to open an account and to send money between users. And so technologies that do that engage consumers at a new level, that solve new problems for those customers and make it very, very easy to onboard, right? To basically interact and migrate from their old way of doing things. Those are the areas of focus that are getting, or the areas of opportunity in the fintech space that are getting a lot of traction.
So how many companies are engaged with it? Even though it's highly regulated, there appears to be a lot of new entrants into the space.
Yeah, I mean, fintech is pretty broad. The classically defined fintech approach is technology platforms and services that are sold to the traditionally regulated institutions, right? Whether it's an investment platform being sold to JP Morgan or E-Trade, or it's software that's consumed by banks or credit unions. That's the traditional space. And there's a tremendous amount of consolidation that has happened in that space over the last decade, or the last 5 years even. But outside of that, there are sort of these secondary and tertiary areas of growth and areas of innovation that are being driven by developer-centric tools and technologies that allow pure play startups, whether they're in crypto or whether they're in crowdfunding investments, or if they're in the ability for crowds to back new products. Basically, the space is very broadly defined as the intersection between technology and finance. And that, again, that ranges from business to business, software that's sold to banks, all the way over to payment, alternative payment networks, and cryptocurrency. So the industry itself is very broad. We are hyper-focused on specifically the implementation of money movement and facilitating people to allow them to integrate with their traditional financial services and next-generation technology platforms. So bridging that gap between your Bank of America account and Google or Amazon or someone like a Coinbase or a Kraken on the crypto space.
You spoke a moment ago that you're treating the banks more as a product rather than a customer. How does that work exactly?
Well, that's me being a little controversial, right? So many companies get into the space and fall into the trap of working for many, many years and working very, very hard to try to get one customer or a handful of customers in the space. And at the end of the day, they'd have a lot of pricing power and it's difficult to scale those relationships. And I've learned those lessons the hard way. The only thing worse than selling to big banks like a Bank of America or JP Morgan or something like that is selling to small banks. And so I think it's very important, and we're taking this lesson to heart ourselves, but I think it's very important generally as a fintech startup to work on tools and technologies that allow you to scale more easily. And so we're taking an approach, which is we're working directly from a consumer's perspective of creating an interface layer for that consumer that allows them to interact between the technology companies and the brands that they trust on the tech side with where their money happens to be. And so that is what sort of defines the stance of the bank as a product, right? That they're a feature that we bring to the table to facilitate a deal with a technology platform company. Our customers, the technology platform company, the product is the ability for us to package up many banks and offer that as an integration for their tens of millions of consumers versus taking technology and going to the bank and saying, okay, you have 5 million consumers using accounts with your system, with your bank, and here are some technology that you can use to make their lives easier. Those banks are looking at those technologies as cost centers, right, by and large. And so flipping the script on that and effectively monetizing the 240 million U.S. consumers that have established banking relationships at banks in the U.S., I think is a different approach. And I think is an approach that more companies need to take to accelerate the commercialization of some next generation financial tools.
I think that's smart. I think the biggest mistake I see people make in this area is they treat the banks as a competitor. And it's very rare that someone's app is going to take down any big bank because of the size they have, the inertia that's in the system, and the fact that it's highly regulatory. There's just only so much you can do. And so treating them in that way gets you around the issue of competing with the banks, which never seems to be a successful path going forward. So what's the next step for you guys?
So the next step is scale, right? So, but before I get to that, I do want to address the point you just made. And I think ultimately the opportunity space that we're really focused on, the way our technology can play out, can really change that trend that you just talked about, right? So let's think about fintech broadly. So if you look at some of the next generation platforms that are out there that are trying to disintermediate traditional consumer finance, right? Whether they're Robinhood or Mint or Wealthfront or SoFi. There's a variety of examples. So those companies are all trying to sort of disintermediate where your money currently is and get you to move your money. So over the last 10 years, that has gone from a nascent industry to something where there might be 40, 50 million US consumers that are actively engaged in one of these next-gen platforms. The growth opportunity is still huge there, right? So the question is, and this gets back to the original point about areas that reduce friction, technologies that reduce friction are some of the real upsides to this market segment, or where you as an investor could look to put some money. Because that lag between and that challenge of getting people to move from an established banking relationship to a software company, in some ways, that is obviously a large hurdle. But it really shouldn't be, because those banks don't do software very well, right? I mean, think about all the apps that are on your phone for managing your money. And how few of those apps are really, really great user experiences? And the answer is probably none of them, right? You might have 5 or 6 apps on your phone for various different accounts, all replicating the same functionality in different ways, and they're all pretty terrible user experiences. So a pure play fintech company that really is focusing on consumer experiences like a SoFi or Robinhood, things like that, those companies know software and consumer experience very well. And so I think that the future looks very, very bright for those companies because of technologies like ours that can basically eliminate that friction for integrating between where the money happens to be and where the consumer experience wants to go. And you can do that and sidestep the need for directly replacing the bank by treating the bank as almost like a layer 2 network, right? They keep all the regulatory burden, they keep all the necessity for securing your money and all that kind of stuff. But then you can have a software company that comes in over the top of that and innovates with new financial products and new services and new networks without having to take on all of the regulatory and compliance baggage of the actual depository account. And I think that's a hybrid future that we're going to see accelerate radically. And if we do our jobs right, then I think you're going to see an enormous growth of engagement with those fintech platforms over the next 5 years.
Would you call that a middleware solution, or do you have a different term for it?
There's not really a really great term for it. The best example of a term that describes those type of technologies today is financial data aggregation, right? So getting a direct integration with financial institution is a challenge for companies. It takes many years, and it's very difficult to scale those, right? So you end up with partnerships like Apple is doing with Goldman Sachs for the Apple credit card, right? Or Amazon's deal with Chase for the products around Amazon issued credit cards or Amazon branded cards. So you end up with those kind of deals in the world that we have today and the players that are in the space today. And so the world is right now powered by these financial data aggregation companies like Plaid or Yodlee or MX that have the ability to sort of force middleware integration or a cloud-based integration between all of these different financial institutions and investment firms and the technology companies. And so there's a variety of very high-value startups that are currently in that space. What we're trying to do is take that group of companies that are financial data aggregation companies and take that to another level by having revolutionary technology. And I hesitate to call ourselves a financial data aggregation company because we don't do the aggregation point of financial data aggregation, right? So those companies are able to do what they do because they scrape data from all these different consumer accounts, put that data in one place with a set of access credentials, and then provide that data to technology companies that need that data to power their fintech product, right, or their technology product. And that's gotten us this far. But where we're investing and where we're putting our resources and finding a lot of traction in the space is by eliminating the aggregation portion of that, right, by basically moving the technology integration point to your personal device, right, to the edge of the network, and creating a permission-based, highly secure virtual network, right, that's all based on you, the accounts you have, your device, and all of your data and your access credentials stay on your phone. So while it would be the easiest analog to what we do is financial data aggregation, because we literally have no user data on our network, the term doesn't really apply to us. So we're a little bit of an odd duck from that perspective. But I do think it's something that is really going to be key to the next stage of hypergrowth in fintech.
You're right. I'm not quite clear what the actual term is, but we can keep thinking about what that might be. But it looks like a good combination of new tech with old banking acumen put together in a better solution for the customer. But in the last few minutes that we have here, what else should we cover that we haven't?
Well, we started the conversation talking about privacy. We talked about some of the challenges that are facing the industry with privacy and user data privacy and security. And that is an example of something that I would call an externality, right? So when you're doing a software company, you have a very tight focus on a specific product in a specific market, and you're trying to find a willing customer and good product market fit. And you are taking a big gamble with the approach that you're taking with your product and what's underpinning what you're doing. And sometimes you get hit out of left field with an externality. And if you've chosen wrong, then it can create a fundamental problem with your business model. And we were very, very fortunate 3 years ago when we got started with this, that we were taking a very contrarian approach to user data and user data privacy. We looked at the market and we said, okay, the key players here, these guys that like Plaid that have multi-billion-dollar valuations, their business model is entirely based on the willingness for consumers to share their data, aggregate their data in one place with their credentials, and allowing that to be a cloud-based integration point. And so we took a completely opposite and contrarian view. And there is a version of our reality where that didn't pay off, right? Because there weren't necessarily the privacy scandals, or there weren't the big hacks like we had with Experian and things like that sort of changed the conversation, right? That could have very well happened. But those events did happen. And so now people are very hyper-focused on and very sensitive to who has access to their data, where their access credentials are, and how that data is accessed. So we were a beneficiary of that externality. And I think that is something that investors and entrepreneurs, you can't predict those things. But going forward, I think that we are entering a new era where it is critical that when you're developing these systems, you can't think first about scale and first about how to maximize the amount of data that you can control, right? And you need to instead think, how can we maximize our ability to be a good steward with the integrations we have, with the user data we have, and how can we strike a good balance between functionality and frictionless onboarding and interactions with our software, and at the same time, not creating the next Cambridge Analytica. So, yeah.
Well, great. Well, it sounds like an innovative solution to a long-standing problem, so we'll look forward to seeing how it plays out. How best for the listeners to get back in touch with you?
So you can come to our website. It's appbrilliance.com, and you can always email me directly at eric@appbrilliance.com, and check us out on LinkedIn and all the standard ways you can reach out to us.
We'll put those in the show notes. Thank you for coming on today, and hope to look for a follow-up very soon to see how it's going.
Well, thank you very much. It was enjoyed spending time with you, and I look forward to connecting with you guys in the future as we grow.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.